The cranes at Fangchenggang hoist the lion's share of global trade in and out of southwest China's Guangxi-Zhuang region. Loads like these sacks of aluminium oxide are usually settled in US dollars, the world's leading reserve currency. But volatile exchange rates are adding to the pain of the global slowdown. So to counter this, China is promoting its renminbi, albeit quietly, as this region's trade currency of choice.
The design is meant to stabilize the cross-border trade when the exchange rate vis-a-vis the dollar of some of the regional currencies are very volatile. That's hard to anchor, traders' expectations. I think to that extent it is a good move.
Many Chinese exporters agree, adding they'd see their money sooner with renminbi settlements. Better cash flow would mean reduced interest payments, and in a global slowdown, every cent counts.
To use the renminbi, the payment cycle is short. The company benefits from using the renminbi, and trade flows faster.
China wants to help its struggling manufacturers, but with some $2 trillion in reserves, it must trade cautiously. So for the meantime, only companies from Guangxi-Zhuang and neighbouring Yunnan province can opt to conduct cross-border business in renminbi, while the renminbi trading partners are limited to those based in ASEAN countries. In a nutshell, this voluntary initiative shouldn't make waves.
I think symbolically it's an interesting step, it's an important step, but I think in the grand scheme of things, especially how little border trade as a share of China's total trade, I don't think it's that serious.
And small it is, even if everyone agreed to use renminbi. In 2008, trade between ASEAN and the two selected Chinese regions amounted to just 3% of China's total $230 billion trade with the bloc. Or to put it another way, a mere 0.25% of China's $2.6 trillion global total. But according to a government think tank, there's a lot more to this limited cross-border renminbi plan than meets the eye. For it's actually just step one in a long-term strategy to internationalize China's currency.
In addition to ASEAN, the renminbi can then be used as a trading currency with India, Pakistan, Russia, Japan and Korea. And the third step is to use the renminbi globally. That's the general plan.
Actually, this is a huge plan that's aimed at reducing the US dollar's dominance as an international currency. But first, Beijing has got its work cut out. The country needs a social safety net to help it through any financial shocks. And it should also liberalise its capital account and the convertibility of the currency. Only then could the renminbi hope to join the reserve currency club.
And right now, I think we're not there yet. Still, we need a lot of time to build up this China's capital market, banking system, and also the social security and the insurance systems.
As for a time frame, the jury is divided. Optimists cite 15 years, the pessimists 40. For now, China will pay for Brazilian sulphur in dollars. Nonetheless, neighbouring governments, even the US, welcome measures, albeit modest, that allow greater international use of the renminbi. But some ASEAN traders still need convincing. A slow transition of the renminbi to a regional currency actually suits Beijing, given both its huge exposure to dollar-dominated assets and the recent G20 agreement to support a dollar-centred currency system. But the die is cast. China's timely goal is to free itself from today's hegemony of a foreign currency.